Hi. I am Hazel Crimebot 3000, and today I am taking you on a journey through some of the history of financial crime and fraud in Australia. In 1900, when the colonial states federated to become the Commonwealth of Australia, the states updated their criminal codes. In New South Wales, the Crimes Act Section 188 Part 1b, defined receiving stolen goods to mean knowingly receiving goods that were stolen in a way that met some severity limits. Thus it wasn't always a crime to receive stolen items, provided they were not stolen in a manner that amounts to a serious indictable offence. Section 192E of the Act makes fraud a crime without mentioning a definition of what fraud is. Special mention is made that fraud may still be committed even if someone has agreed to pay for an item. It wasn't until 1988 that the Financial Transactions Reports Act was introduced. More on this in a minute. The Proceeds of Crime Act of 2002 was a response to high-profile individuals profiting from their crimes after the fact. Schapelle Corby, of the infamous Weed in a Boogie board bag, and arguably Australia's most notorious crime figure, Mark Chopper Read, were making money from interviews and books about their criminal past, leading to an outcry on how convicted criminals could continue to make money from telling stories of their illegal activities. This Crimes Act allows the Crown to seize assets that were gained through criminal activity or as a result of a criminal career. Until the end of the 20th century, money laundering was seen as an act of hiding the proceeds of crime from law enforcement and taxation agencies. In the early 21st century this shifted as it was recognized that money laundering was also being undertaken to hide the destination of funds to terrorist organizations. The 2006 AMLCTF Act sought to address that. It was now a crime to send funds to defined terrorist organizations regardless of how the funds were obtained. From 1900 until 1988, banks had no legal obligation to make any enquiries on the source of funds being deposited. Provided a bank did not knowingly receive cash that resulted from a criminal enterprise, they were free to process cash deposits for anyone. How the customer transacted and where their money came from was their business and was of no concern to the bank. Banks were not law enforcement, their role was to provide safe and secure financial services to all customers. It was the cops' job to catch crims, not the banks. Customer privacy was king. Bank staff were strongly discouraged from discussing anything about a customer's business. If a colorful racing identity turned up at your branch every Monday morning with a bag full of cash, no questions were asked. That cash was discreetly counted and deposited to the customer's account. That all changed in 1988. The Financial Transactions Reporting Act required banks to report all cash deposits of $10,000 or more to AUSTRAC. That limit was not indexed, meaning that over time the reportable limit has effectively been decreasing, catching lower real value cash transactions as time progressed. The first pass of this act required banks to complete the report in front of the customer and have them sign it. Since then, amendments to the Act forbid banks from informing customers that such reports have been generated. FTRA also introduced stricter identification requirements when opening bank accounts, known as the 100-point ID check. Any customer opening an account needed to provide a number of forms of ID, with different types of ID being worth a number of points. As an example, a full Australian birth certificate or passport is 70 points, a driver's license is 40 points and a Medicare card 25 points. Concessions are made for people under the age of 18, recently arrived in Australia or belonging to a group which generally has low levels of personal documentation, such as residents of remote indigenous communities. The aim was to prevent accounts being opened under false identities, a relatively common practice used to evade income tax at the time. The 100-point check requirements have been updated since the first inception. Banks no longer store physical copies of birth certificates and tax file numbers, but the digital storage requirements of this check has far-reaching impacts. Data security breaches where personal information has been stolen, is directly related to the 100-point ID requirement of the FTIA, that proof of documents be recorded. The 1988 Act had no foresight on the volume of documents companies would need to securely hold in a digital world. The FTIA 100-point check has created its own problem, where once it made it harder to open an account in another person's name, it is now easier for criminal organizations to co-opt all the documentation they need from a single data breach. In 1988, the only way to open an account was in person at a bank branch, where the staff member could view all of the documents, check their condition and verify photo ID. In the digital age, these checks are weakened as new customers can establish themselves via digital channels. The FTIA has not kept up with technological advancements and is arguably no longer fit for purpose. For 30 years, AUSTRAC monitored transaction reports from banks. No Australian bank had ever been fined for a failure to report transactions during that time. Then on 4 June 2018, Commonwealth Bank settled with AUSTRAC for contravening the AML-CTF Act, on 53,750 occasions. CBA had failed to monitor or report significant cash deposits made at Intelligent Deposit Machines, their newest generation of ATMs. The penalty was $700 million. On the 21st of October 2020, the Australian Federal Court found Westpac guilty of breaching the AML-CTF Act, for failing to monitor international money transfers performed on their small value FX service. For this, Westpac was fined $1.3 billion. Any notion that the banks had, that AUSTRAC would go lightly on them or just hand out warning notices, had been unequivocally quashed. All banks were now on notice. AUSTRAC was serious about failing to monitor every customer-generated transaction. The AML-CTF Act also introduced requirements for banks to know who their customers were and to conduct appropriate due diligence on them. Customers in high-risk categories would need reviews when they were onboarded, and the highest-risk customers would also require additional annual due diligence reviews. Categories of people who were at a higher risk would require additional ongoing transaction screening, to look for money laundering, corruption and terrorism financing activities. In Mesopotamia in 1750 BCE, a man named Ari sent his servant to buy copper ingots from Iyasa, a copper merchant. Ari then wrote a complaint to Iyasa in Akkadian cuneiform, saying the copper was of a poor quality and his servant was also treated rudely. This is the first known written complaint that also records the participants' names. At the same site were a number of other clay tablets with similar complaints to Iyasa. This suggests the copper merchant was providing poorer copper than that which was paid for. It may have well been the earliest written record of a case of fraud. I set my researchers to the task of finding Australia's largest frauds. But it was a difficult process, as there were some major financial events that met the definition of fraud that were not called frauds at the time. In the 1980s, each Australian state had its own state bank. Times were booming and new CEOs joined those banks to make them entrepreneurial. State Bank of South Australia and State Bank of Victoria suffered similar fates. Their CEOs went on a financial buying spree, picking up high-risk and high-reward finance companies. In the short term, these ventures produced huge returns and resulted in massive bonuses for the executives of these banks. Ultimately, the houses of cards collapsed and the political fallout caused the state governments of SA and Vic to lose office. Big lies were told and a few people made a lot of money, but it was never called a fraud. Although Australia is not short of fraudsters, two names come to mind for the Big Fraudsters Club. They didn't cheat little old ladies out of their pension money or dupe greedy investors in get-rich-quick schemes. These two each took on the Australian financial markets and at least for a few years got away with conducting multiple big money frauds, while smart financial analysts looked on and applauded the entrepreneurial acumen of these two men of industry. Our first villain is Friedrich Hochberger, who worked as a contractor for a road construction company in Germany in the 1970s. He issued fake invoices and defrauded the company of 300,000 Deutschmarks. When he was discovered, and facing arrest, he faked his own death, reappearing a few years later in Australia as John Friedrich. When Friedrich joined the National Safety Council of Victoria, it was a small volunteer organisation which focused on road, sea and industrial safety. John quickly rose up through the ranks and transformed the NSC into a national search and rescue, and firefighting organisation. At its peak, the Safety Council owned a fleet of helicopters, planes and ships, trained rescue dogs, satellite communication, parachute rescue and a mini-submarine. Friedrich falsified and fabricated assets to secure loans to fund further growth of the organization. An audit eventually discovered the deception, uncovering a fraud of $297 million, although it appeared that he had gained little personally from the fraud other than status and false glory. Alan Bond was a much-loved Australian larrikin, rising to peak popularity when he funded the construction of the yacht Australia II. This yacht raced in the America's Cup against the New York Yacht Club, who had held the trophy undefeated for 130 years. Bringing that trophy home to Australia earned Bondi the Order of Australia. After leaving school at 14, Alan went on to amass a fortune in real estate, through the expedient means of buying property first and then working out how to finance it afterwards. After buying an office building in Perth at auction, he sent an associate to the bank to seek finance for the 10% deposit he needed to pay in an hour. He went on to own a brewery, invest in mining and founding Bond University. The start of his downfall occurred when he attempted to buy a Channel 9 TV station from Kerry Packer. Bond paid $800 million in cash plus a $250 million credit note to Packer. The strain on Bond's creative accounting started to show, and when it fell apart, Bond became bankrupt with $1.8 billion of debt. Kerry Packer retook control of the TV station he had sold Bond less than a year earlier, to settle the $250 million debt. Kerry Packer was quoted to say, "You only get one Alan Bond in your lifetime, and I've had mine." Bond's family bailed him out of bankruptcy by paying creditors at a half a cent per dollar, but that didn't fix his financial woes. In an attempt to shore up his private company, he fraudulently moved $1.2 billion from Bell Resources to cover Bond Corporation's debts. Even this massive injection of funds was unable to save the company. Shareholders of Bell Resources sued Bond. Alan Bond was found guilty of fraud, sentenced to 4 years in jail and stripped of his Order of Australia. Crook or hero, he is still one of Australia's great characters. A final note on banking and crime in Australia. The second half of the 19th century was the halcyon days for bushrangers, who were hailed as heroes by many at the time. The Kelly gang roamed Victoria and New South Wales, plundering almost at will. In February 1879 the gang took over the town of Jericho, holding the local constabulary hostage. Dressed in police uniforms, the gang robbed the hotel, post office and bank, where they took and burned loan documents and mortgage deeds to help the downtrodden local population. In June 1880, after having murdered a police trooper, the gang made a plan to attack a police train heading to Glenrowan. In their usual style they took the entire town hostage, though graciously held them at the hotel and gave them food and beer. The police arrived at 2 a.m. and for the next 14 hours a battle ensued. Ultimately 4 of the Kelly gang and 2 hostages were killed, and the troopers burned the hotel down. Ned Kelly, the only one of the gang to survive, was captured with 28 bullet wounds. He was tried, then hanged at Melbourne Jail in November 1880. Ben Hall and Frank Gardner led a variety of bushranging gangs. In one raid they stole gold and cash valued at £14,000, equivalent to $16 million today. Hall is attributed with over 100 robberies, his bushranger career ending at the age of 28 when he was shot by troopers. Frank Gardner made a profession of avoiding jail for his crimes. He managed at various times to escape prison, was granted an early release for good behavior, absconded while on bail and received a pardon from the New South Wales governor after serving 10 years of a 32-year sentence. He was exiled to the USA where he bought a saloon in San Francisco. From copper disputes in ancient lands to bushrangers stealing gold and burning mortgages, on to corporate fraud for billions of dollars and the current worldwide network of scammers, fraudsters and hackers. The battle between perpetrator and enforcer continues.